The global economy in 2019 has been characterised by a notable slowdown, while at the same time avoiding a full-blown recession. Much of the weakness has been attributed to the trade war, particularly between the US and China, and the uncertainty that's come with it. And the weakness has led to a shift from central banks from policy normalization to policy accommodation. So as the year draws to an end, what will happen next for global growth in 2020? Daniel Lacalle is the chief economist at Tressis and joins me now to discuss. Daniel, good to see you as always.
Always a pleasure.
Let's start with the year we've just had. What's been driving the slowdown that we've been seeing?
Well, I think that three factors. No? I think that the first one is the trade dispute and the concerns about global trade growth. I think that the second one has been emerging market weakness. I think that very few expected the Indian economy to be growing at 5% and the Latin American economies to be so weak. And the third one is debt saturation, is that we've seen that the global debt has risen to all-time highs, and that continues to make economies less productive, less dynamic, and obviously growth suffers.
So it's been interesting to think about the shift that we've been seeing over recent years, because it wasn't long ago that we were talking about that synchronized upswing in global growth. Now we're seeing a notable slowdown. Could that develop into some kind of recession?
It can, obviously. We are seeing signals of late cycle slowdown. Manufacturing PMIs are in recession in most of the more important economies. The service sector is keeping the economy afloat, but that tends to be a lagging indicator. It tends to follow what manufacturing does, after 18, 24 months. But I think that what we lived was the mirage of this concept of the sort of synchronized growth, and we're back to what we already were seeing and was quite evident, which is a sort of global stagnation or a very, very weak growth with low inflation but very high debt.
So in terms of what central banks can do about it, obviously we are seeing this shift towards more accommodative monetary policy, but there are question marks about just how effective they can be at this stage. We've seen cheap money for a long time. Do you expect to see further accommodation, and can it be effective?
I think it's very likely that we will see further accommodation, and that we will likely see central banks taking a much more aggressive stance by changing their target of inflation, by putting more of the resources into sort of equities, even high yield bonds, you name it. It will not work. And the reason why it doesn't work is simply a question of diminishing returns, is that you cannot expect that the policy that works from 5% to 4%, 4% to 3% is going to work at the zero level. And because the problem of most of the developed economies is not a problem of low rates or needing more liquidity. It's a problem of excess capacity and excess debt. So lowering rates further and increasing liquidity basically just makes the economy more stagnant. It makes it less dynamic. It makes obviously another very big problem is the rise in zombie companies all over the world. So we need to pay attention to all of those factors, especially if we have optimistic views of growth.
So we mentioned the trade tensions. Obviously, these have been a lingering pressure on the outlook for the global economy, particularly within the US and China, the two world's largest economies. Do you think that pressure will continue next year? Because, of course, we are entering an election year. Mr. Trump won't be wanting to unsettle things too much, I imagine.
Well, I think that the idea that because it's an election year, Trump will reach an agreement that is not beneficial for the United States is a little bit of an optimistic perspective from the market, from market participants. There is absolutely no evidence that the U.S. administration is going to enter a deal that it does not see as very robust and clearly changing in terms of the relationships with China, and there's absolutely no evidence either that China is going to agree on anything just because somebody needs the headline of a trade deal to buy some stocks. I think that both governments have very clear priorities. My concern about it all is that there is this widespread view that a trade deal would be a trend changer in terms of global growth. And I think that that is a mistake. I think that a trade deal might have a positive effect on market participants' view of risky assets, but little more. And definitely not a change of trend of global growth, because the slowdown of China and the late cycle development of the US economy have absolutely nothing to do with the trade dispute. They have their very fundamental reasons why those are happening.
So you mentioned the slowdown in emerging markets as one of the key drags on global growth in 2019. Where do you stand on the outlook for developed versus emerging markets next year?
I continue to prefer developed markets relative to emerging markets. In a tremendously successful year for equity markets globally, like 2019, the level of risk that one would have had to take in order to achieve the same returns of a developed market in emerging markets was phenomenal. So the return versus risk does not add up. But I'm concerned particularly about the challenge of many emerging markets going into 2020 and 2021 because of the wall of maturities of US dollar denominated debt. Remember that these economies went into a huge borrowing spree in foreign currency in the last 4 to 5 years, and that is its payback time pretty soon. And that coincides with an environment in which export revenues are weakening, in which growth is weakening, so reserves are depleting, in some cases quite rapidly. So I would continue to be cautious about emerging markets as as a concept. Obviously, there are pockets of opportunities, like there always are.
So you mentioned the fact that markets have had a pretty strong year, particularly developed market equities. I mean, when we think about the fact that global growth is slowing, yet markets continue to press all-time highs, something feels like it doesn't quite add up. I mean, what's going to give next year? Yes,
I think that the reason why markets were so strong in 2019 was because, first, we all thought that there was going to be a massive recession, or at least there was a wide consensus view that there was going to be a massive recession. It didn't happen, so relief. Second, last year, very weak market, so the recovery process. Third, monetary policy. The year of normalization became, as you said in the intro, the year of being even more accommodative, particularly in China and the Eurozone. And what we have seen is that global markets have risen despite weakening global growth and also very, very weak earnings growth. So what we need to be aware for next year is that many outlooks are calling for a rapid move up of earnings estimates and an improvement in the global economy, particularly into the second half of the year. You need to be extremely cautious about those two things. You need to be extremely cautious because the capex cycle, the debt cycle, and especially in terms of capex, gross capital formation, everything that has to do with spending is also at a peak level. So I would be at least cautious about those expectations.
So given your caution, how does that link to your outlook for precious metals? And I'm thinking about gold particularly. Is this the time to buy gold? Is that going to provide a tailwind to the complex?
Well, I think that gold in 2020, it is absolutely key that if you want to have some level of hedge relative to the risks that we are talking about, and obviously to see something that on fundamentals is also working quite evidently, gold needs to be a part of your investment portfolio. I think that is something that I would be I would say, clear about. The other thing that I think is important is that in 2019 what we have seen is a recorrelation of the US dollar with gold. So gold and the US dollar have strengthened in tandem. That is not a sign of exuberance, that is a sign of caution. And I think that we should also be relatively positive on US dollar on US dollar assets, precisely because of what we mentioned before, the fact that you have this massive wall of maturities from many emerging markets in US dollar denominated debt, therefore demand for dollar rises. The Chinese shortage of dollars, very evident in the November FX reserves figure, and also the reality that while so many central banks are easing and printing money aggressively, the dollar strengthens not because the Fed is going through a phase of normalization, but because everybody else is going even crazier.
Daniel, thank you so much.
Thank you so much. Always a pleasure.
That was Daniel Lacalle, Chief Economist at Tressis. I'm Victoria Scholar, and thanks for watching IGTV.